Today we've got Vincent Costello, who's the tax director at Assets. Good morning, Vincent.
Good morning.
And also we have Sasha Phillips, who's the tax manager at Assets as well. Good morning, Sasha.
Good morning.
Thank you very much for joining us today, guys, and also for the insightful information you're about to give people watching us. The log, the podcast, that thing which is going on social media right now. The hot topic today is a question we get asked a lot, is what allowable expenses are allowable for landlords on a buy-to-let property. And it's confusing because we know that there was interest rate on mortgages, which is gone.
It's not completely gone. So up until I think it was 2016, I think it may have been, you'd get full relief on your mortgage interest. And then the government at the time introduced a phasing scale, so you'd get 75% relief on the interest, and then 25%, the 25% you get just tax relief on it, basically. And then on a sliding scale, that went from 75, 50, 25 to being fully zero. So what we find with landlords now is they've got a notional profit rather than an actual profit. Because the mortgage interest isn't a profit and loss expense now. It's a reducer, it's a tax reducer. So whereas you've got a landlord with £10,000 worth of rental income, £10,000 worth of mortgage interest, he's not making any money. But for tax purposes, he's got a £10,000 profit.
Absolutely.
And then you pay tax on the 10,000, and you get relief on the mortgage at 20%, so £2,000 off your tax bill. And if you're a 40% taxpayer, you've got a £10,000 profit, 40% is £4,000. You only got a tax reducer of £2,000, you've got a tax bill of £2,000.
Okay.
But you've not got any profit. That's where we're at with that one.
And we need to make sure that these landlords are making a profit, because ultimately, because there are ways, absolutely ways of doing that. So we used to talk about the 10% wear and tear allowance.
That's completely gone now.
Is it completely gone?
When did that go now?
That's probably been going on for 10 years.
It went quite a while ago now.
So that was a relief where you would be able to deduct 10% of your gross rent, regardless of what your expenses were. And there was a couple of little odd things, like you couldn't have it on council tax, so it was gross rent minus council tax at 10%. Now that's completely gone, but it had to be furnished.
It did need to be furnished.
It was only on furnished properties. So unfurnished, you wouldn't get it.
At all.
It was to give you an allowance for wear and tear. What was wear and tear allowance on your furniture, on your carpets, those kind of things.
So guys, give me some good news.
Well, they have brought in. They brought in this property allowance. So every landlord now, if their expenses are less than £1,000, they can set off £1,000. You don't need to show any receipts. You don't need any records at all. It's just £1,000 that you can deduct, with sort of no worries. Now, I appreciate.
Is that per property?
No.
That's per business.
Per business. So for a lot of landlords, that might not, be applicable to them. But for the landlords with maybe just one property where there's not that many expenses, then they get the uplift to £1,000, which is quite okay.
It's not to be sniffed at. It really is not to be sniffed at. So just to clarify, if a private landlord had 5 properties but not in a limited company, owned like sole trade, they can only get that £1,000 off all 5.
Yes. That's right.
It's a shame, isn't it? But they still get it. Okay, fine, right. So, but that's good though. That's good. So they don't have to provide any expenses. No receipts, no proof. They just get it.
That's right.
Okay.
So it's maybe handy when you got someone who's just renting a garage.
Like
that.
£1,000
knocked off straight away.
Absolutely. That's really good. That is really good. What other reliefs do landlords get on that they can claim back off their expenses
So you've got 2 different sort of things that we look at, 2 categories. So one of those is capital expenditure and one of those is revenue expenditure. So the revenue expenditure, they can set that off against their income from the property every year per tax year. The capital, they've got to wait until they sell the property and then they get the deduction.
Okay.
So the thing is, I think there are some grey areas, aren't there, of the legislation where we have to really look at it and we have to really think, and then there are some things that are very obvious. So revenue expenditure might be, you know, the garden maintenance.
Yeah.
Or
Definitely garden maintenance, not...
Yeah.
We get people putting in fancy new lawns and
yeah.
digging ponds. That's not revenue, that's maybe...
I think,
That's general maintenance of your garden.
That's classed as would that be classed as an improvement?
well, yeah, so generally if it's an improvement, if you are improving the property and you can see that in the sale of the property, that would be capital. So you put on an extension.
Yes.
Well, that is very obviously going to improve
Absolutely.
the property, so that is going to be your capital expenditure.
Okay. Yeah.
Let's say you get carpets throughout the property. That is revenue. And the reason that that's revenue is because it's fixed to the property.
Yeah.
And even though, before the sale it probably does improve it, it's actually a repair to the property itself because it becomes a part of the property, if that makes sense. That's how I think about it anyway.
Because there was always talk about essential repairs and improvements, which is in some respects what you're talking about. Because we always said to a landlord that I'm going to replace a UPVC window for a UPVC window, and we go, why? It's not. There's no benefit, as in, apart from it's a different colour, for example.
Yeah.
But that UPVC window was fine, and the new one was fine as well. But if that UPVC window was I don't know, broken or scratched or whatever it might be, they had to replace that for a new one.
Yeah.
Could they then claim that back versus?
Yes.
Yeah.
So, and the reason being is because that's just replacing it with a modern equivalent.
Okay.
Even though it's an improvement to the property in some way, it's just a replacement.
Yeah, this is where the grey area comes in.
Yeah.
With the revenue capital divide.
Yeah.
So you could have a new fitted bathroom and a new fitted kitchen and class it as a revenue expense, as long as you're replacing like for like.
And it does the same thing.
It does the same job, it's of the same standard,
Yeah.
it's just a modern equivalent.
Yeah.
So that would be classed as capital. Revenue.
Revenue.
That would definitely a revenue expense.
Yeah. Yeah.
But if you replaced your bog standard MDF kind of worktops with a granite worktop, that wouldn't be revenue, that would be capital.
Yeah.
So in your kitchen, you've replaced everything you've got now, twice as much space as you had before, storage space.
Yeah.
You've replaced MDF with granite.
Yeah.
That's clearly not
Okay.
a replacement, that's a capital. So that's where the grey area comes in.
Yeah.
Stuff like windows, like Sasha was saying, if it's a modern equivalent of, so 15, 20 years ago, everybody was replacing the single glazed windows with double glazed PVC ones.
That's right, yes.
That is definitely a revenue expense. That was never classed as a capital anyway.
Yeah.
Revenue recognised that
Yeah.
and made allowances for it.
And same with boilers. Same with boilers,
modern
isn't
equivalent,
it? Modern equivalent of a boiler, that's deductible from the revenue.
Okay.
It is revenue expenditure.
Yeah.
Well, because landlords have obligations to keep the property up to to make sure.
Yeah.
To a standard,
Absolutely.
Yeah.
So they've got running water, they've got to have heat, they've got to have roof over their head, electricity, and so on and so on. So as we all know, kitchens will last potentially 15, 20 years depending on the use. But then they do need replacing. They get burn pans on the side, and as much as tenants are brilliant looking after properties, sometimes you have accidents. We have accidents in our own house, and you do need to replace that like for like kitchen. And again, a landlord would generally, I'd be very surprised, and they would definitely having the wrong advice if they're replacing it from, like you say, from a wooden MDF top to a granite top. It would look great. I completely understand what you're saying, but if they were to replace MDF for MDF, that's fine. And it wasn't every year they did that.
Yeah, that's absolutely fine.
Yeah.
Well,
Okay.
I had a client a year ago who had £30,000 worth of expenses
Okay.
in this house, and I did have to ask them the question because a lot of the receipts and the invoices he was giving me didn't seem quite right to me.
Okay.
So things like a £2,000 mattress. Now you wouldn't normally give your tenant a £2,000 orthopaedic mattress. You wouldn't put flat screen TVs in all your rooms.
No, that's right. Yeah.
You wouldn't necessarily kit out the kitchen with smeg
Top
appliances.
spec. Yeah.
So I had to have the conversation with him and say, is this right? Is this all for this house? Bearing in mind you live next door as well.
Yeah.
Are you sure?
Interesting conversation. Yes. Yeah.
I mean, to be fair, he got the hump with me.
Okay.
He was really on to me like, who are you to question me? Well, I'm only doing my job.
Absolutely.
Because at the end of the day,
Because we have to do it.
Yeah, if you get an inquiry, you've got to be comfortable that all these expenses that you're claiming are revenue are revenue expenses.
Yeah.
The HMRC have got massive powers. They can go into that property and say, hold on, that's not there. That's a Sanyo 15-year-old TV that's probably worth minus £20.
Exactly.
You claim £2,500.
That's right.
But they have the power to do that.
Yeah.
The HMRC have more powers than most people know.
And ultimately, for us, we've got to assess the risk because we don't want any of our clients getting into a position where we're having to argue with the revenue.
Yeah.
We want to make sure that we're completely comfortable with everything and that we're protecting our clients and looking after them.
Yeah.
It's a very, very, very valid question because landlords do say, the boilers are a great one as well, because the average lifespan of a boiler nowadays is probably 8 years. And landlords keep saying, well, I'm going to repair it and spend £200 and repair it and another £200. We're saying, listen, replace the thing because you spend £200 now, you don't know what you're going to spend in the next few months trying to, if it breaks down
Keep
again.
it,
Which inevitably they do. And the hindsight, landlords often say, I should have replaced
Just done it.
Like you said. But let's say that boiler was £2,000 to replace a mediocre boiler for a mediocre boiler. In fact, boilers are, you could spend maybe £3,500 on something like a Worcester, which are the all singing, all dancing boilers versus £1,500 on a, well, it's not a B&Q special, but like an equivalent B&Q special. That would still, you could still claim the Worcester boiler because you're investing in, it's longevity of a boiler because you'll have a 10-year potentially guarantee on that Worcester boiler.
Yes, things like that.
That's fine.
I
would say that's compared to the property.
You would look at it.
It's an integral part of the property, and I think
you'd look holistically at what are we replacing here. If you've got an old, I don't know, Economy 7 boiler, and then you want to put a £3,000 Worcester in, then I've got no problem with that because it's more environmentally friendly, more efficient. It is a modern version of what you're replacing really. That's just gone. So things like that. Again, you've got to. With a lot of things with tax, it's about identifying the risk and managing that risk. So what we're looking at, what we've got here, we've got a boiler for a boiler. That you just can't buy them anymore. So we're replacing it with this. That's okay.
Okay. It's interesting because the if we took that £3,000 boiler and let's say they had a kitchen in the same year, and the kitchen was £5,000, which is generally what a kitchen would cost you with a new hob and taps and that kind of stuff, including fitting. So you've got £8,000 worth of expenditure there, plus replacing some really old rotten wooden windows for some UPVC would call another £2,000. So we've got £10,000 worth of expenditure on property A in that year. And the rent was £10,000, for example, just to keep it easy. Am I right in thinking they wouldn't have to pay any tax on that because they're neutral?
That's correct.
So if you've got more than one property, you pool all the income and all the expenses and report that as one. And with self-assessment, you tax everything as a group. So you look at your rental income as a group.
So say property A has a loss, and property B has a profit, then we can offset that loss against property B, and then you'll be taxed on the outcome of whatever that figure is.
And if it is an overall loss over both properties, you can then carry that forward to be used against the profits of the same business in the next year.
It's an interesting point. I think the misconception of a lot of people is, well, it's going to cost me a lot of money now, but it is. But you don't have to, it'll come off your rental income that you're getting.
That's right,
And I think having that message going to landlords, so they're going, oh, okay. Do run a lot of landlords might know, but landlords definitely don't know if you get asked that question.
And the thing is, we would welcome clients asking us that, or people ringing and asking the question, because I'd rather them ring and be comfortable with what they're going to do than do it and then afterwards, it's a capital expense, I didn't realise I was going to get relief now.
What we also see with clients as well is they'll spend the money and think it's not allowable, so won't tell us about it. So I always say to clients, give
us everything and then we will help as best we can.
We'll make the decision what is allowable and what's not. We'll present it to you.
That is really interesting. I think having that knowledge. I mean, knowledge is power. And, you know, you guys do this all day, every day, and it's really interesting hearing the feedback that some clients, what they do try and do and what they don't do.
Yeah.
We've got to hear the end of this story, by the way. So the so the £25,000 bill that you put in for everything else, he or she or it, so you know, so what happened was the end.
So I addressed the concerns.
Yeah.
I told him, you've got to be comfortable with this.
Yeah.
But at the end of the day, it's your tax return.
Okay.
It's your name that goes on it.
Yeah.
And it's you who's got to be able to substantiate these expenses.
And he signs it.
And he signs it. So
Yeah. Okay.
on that basis, if you're telling me everything, you'll give me all the answers that I want to hear.
Yeah.
If you're comfortable with that,
Yeah.
then I'll prepare your return on that basis and we'll submit it.
Wow.
That's
Okay.
what we did.
Yeah.
That's what we did.
Okay. Interesting. I mean, that's everything a knock at the door. But the layman, but you said it's...
It depends on which door it is. It's outrageous. Next door is
But I think people have to know what they can spend, because it will help. It'll improve the property. They can potentially get more rent from the tenants and putting the rent up if they spend something like a new boiler. I've got a brand new boiler, and oh, amazing, great. That old one that kept breaking down for the last 2 or 3 weeks. Yeah, I know, we're getting a new boiler, and they go, thanks for some. Well, I can see, you know, you're actually investing in the property that we're living in.
And it improves their relationship as well then, doesn't it?
It does.
My sister lives in a rented accommodation. We were having a barbecue last weekend.
Yeah.
And the fence panels were all broken. And the guy who owns the house won't fix them. I'm like, it's £35, just put them in.
Yeah.
You get relief on it anyway.
Yeah.
It's
And
going
it
to
make a massive
It's going to make my
difference.
sister happier.
Yeah, absolutely, yeah.
Your tenant's going to be happier.
Yeah,
Yeah.
And that's the thing, you know, by paying the rent that tenants are paying, you know, and it's not cheap. Nothing's cheap. It's not cheap, but ultimately, the landlord has repairing obligations. That's what we keep telling our landlords and keep telling, you know, that you've got to do this. I'm not living there. I'm not repairing that fence. Oh, with the greatest respect, that's what you have to do. And sometimes we've got to be quite a bit like you, your client, got to be quite blunt, and they might not like us for saying it, but we've got to say,
you've got to do it. It's,
you know, you got to put that tenant hat and landlord hat on and go, you know, how would you think? And then a managation hat, it was always caught in the middle. It's your fault, it's your fault. Which I'm sure you guys get as well, the HMRC and the accountants and everything else, but and the clients. But that's really interesting. I think knowing what the expense can have, and again, the moral of the story is always ask advice from your tax specialist to say, can I do this? I'm looking at putting a kitchen in, and if you say, oh, granite tops, don't put them in, you know, unless you place a granite for granite. But fine, you know. Which again, there'll be some properties that will have, you know, amazing, you know, 30, 40, 50,000 pound kitchens, and they're, you know, one of those griddle pans which I've done myself, chips a quarter of a unit, and it's like, that wasn't a cheap moment or bonus, and the look I got from the partner just like,
oh no.
So, but it happens, and accidents happen, and you know, if you're replacing like for like, then it's liable.
Yeah.
And with landlords as well, these gas safety checks.
Yes.
So legal requirements that you've got to adhere to. So
Good point.
those kind of expenses are all allowable for tax as well.
Okay.
So you can claim relief.
Including management fees.
Management fees, management fees.
Yeah.
The VAT that comes with management fees as well.
Yeah.
You can claim for all of
Oh,
that.
you can claim the full amount.
Full amount.
Oh, okay, that's
You
interesting.
can claim the full amount.
Interesting. Okay. And so you obviously mentioned gas safety. You've got your energy performance certificates now that have come in, and Legionella testing you've got to do, and you know, buying smoke alarms and buying carbon monoxide sensor alarms. And,
they're all fine.
They're everything that is justifiably justifiably spent on that investment. Okay.
Yeah.
Absolutely.
As long as you're not
Cleaning at the end of tenancies.
Okay.
Yeah, cleaning, redecorating,
Yeah.
anything like that. All good.
loss of rent, so I suppose you're not getting the income for that rent, so you're not going to put your tax return anyway.
That's right,
Is there anything else that landlords would want to claim against apart from that, because it's a building of a property?
I would say maybe a bit of mileage. So if you're travelling to and from properties, if you've got if you've got quite a large portfolio, say 5 or 10, and every week you go visit one of them. So you're home to the
one in America and the one in Australia.
During half term.
get your point. But I think but that's interesting. You could claim the mileage expense from home to...
Again, as long as it's reasonable. Anything that's sort of reasonable.
Yeah, reasonable expenses. Mileage you'd claim at 45p
Okay.
for 10,000 miles and 25p thereafter.
Okay, yeah.
But like I says, anything you can safely associate with the management of that property,
Yeah.
you would be able to claim as an expense.
Yeah.
Amazing. Guys, that's been really, really, really informative, and I think landlords are going to look at this and go, I didn't know I could claim back on that. I didn't know this. And quick question before we wrap up. If they didn't know they could do it, they'd done their own tax returns, or a friend at the pub done their own tax returns or something, and hasn't claimed something back in a certain year, are they allowed to go back?
Yeah.
You can do up to 4
They
years.
can 4 years.
4 years.
That's right.
Okay,
yeah,
okay. That's interesting. So if you haven't claimed back, then look through your tax returns and see what you can claim back. But I think, in my experience, what we do tell our clients is make sure, a bit like you said, just write everything down. When it happens, get a spreadsheet on your computer, or when you spend, it might be that you go and do a quick visit. On the way back from that trip on Sunday with the kids in the park, I'm going to look at this property. That just those 3 miles. I mean, it's not an awful lot, but
but every little helps,
every
doesn't
little
it?
helps, exactly. That's right. And I think if you're writing everything down, every receipt you're spending, every invoice you're getting. I get a camera, I get a phone, take a picture of the receipt, and put it into a file.
And there are apps now as well, aren't there, that you can get for that.
Yeah.
So easy
And
peasy.
absolutely easy peasy. And then we just send it all to the accountants and and you go, cheers.
And then we get a bag of rubbish.
A big box like, there you go, that's 4 years worth of my account. But no, that's been really interesting. Thank you very much for that, and I think it's really, really, really going to help people out. So, amazing.
Lovely.
Great, thank you.